A powerful country is collapsing. I'm your host, Steve Metre, and thanks for joining me today. In our headline story today, we have new evidence that shows the economy of a major superpower is in dire shape. And wait till you see how the media is spinning it. And not just their media, but our own media is spinning this as good news. But wait till you see the underlying data that we're going to look at, and you're going to be shocked to see that the situation there is far worse than we thought. Plus, we have an update on an ongoing story that goes to show that the global economy is indeed slowing down. And plus, we have a sponsor for today's show. I'm going to give you 7 reasons why you may want to add this stock to your portfolio, plus a chart set up when you see it that shows that this stock, as we believe, is poised to make some big moves to the upside. Stay tuned to the end of the show for more information on our sponsor. And now let's head over to Bloomberg, where we picked today's story up with a headline: China's economy shows strong recovery as COVID era ends, and the manufacturing PMI records its highest reading since April 2012. Now, I wanted to just stop right there and see what the media is spinning here. Now, remember, this is Bloomberg, and they're saying the Chinese economy is again booming, the highest reading since April 2012. So you would have to expect that these numbers are just off the charts, saying that the global economy is not slowing down. In fact, it's rebounding in a big way. But wait till you see the underlying data. The Manufacturing Purchases Manager Index rose to 52.6 last month, the highest reading since April 2012, which more suggests that the Chinese economy has been in a big problem for the last decade. And non-manufacturing gauge measuring activity in both the services and construction sectors improved to 56.3, which is a far better number. And what I want you to understand is this 52.6 number. So what it means is at a level of 50, it means that from the prior month, the manufacturing sector is unchanged. So whatever output, whatever it's doing, is no better or no worse than the prior month. At a 52.6, it means it's marginally improving. So if you're looking at it and saying, hey, things there are bad, their economy is in a dire shape, it's really slow, a slight improvement is not a big deal. But notice again, the spin is the biggest number since April 2012, which suggests the Chinese economy is really in dire shape here. Although there were significant seasonal and event factors, there you go, influencing the figures, the overall trend still points to a solid recovery at the beginning of this year. So already you start looking at what China is saying here. Hey, we had significant seasonal and event factors that may have caused this one-off number, which is not very good to begin with, to be better than everybody expects. But don't worry, we're going to print it anyways because we want you to see it. The decent PMI readings provide a positive note for the upcoming National People's Congress, with the government expected to roll out further supportive policies to cement the recovery. And again, you start to wonder why you would have such a number that looks a little bit better than it has, well, in 10 years. Well, of course, when the National Party gets together, you better have some good news to go with it. Economists have cautioned that even the improving factory data suggests the recovery is becoming more balanced, and there are still headwinds as global demand remains weak and exports are likely to contract this year. And wait till you see where we're going with this story today, because when we get to the end of it, you're going to be blown away just to see how bad things are in China. And it's not just a Chinese issue we're looking at, it's a global issue. All right, let's continue on. Other data signaled a pickup in domestic demand as China's home sales rose in February from a year earlier, the first such increase since June 2021. Road congestion in major cities has increased, subway ridership has returned to pre-pandemic levels, and restaurant and mall spending has risen, giving you every indication, if you didn't have one to begin with, that things in China are better than, of course, we thought, which is what the world wants to see. China's economy is recovering faster than top officials have expected, with the COVID outbreak on reopening passing rapidly through the country, suggesting the government will be restrained in rolling out new stimulus measures this year. Again, everything is better than we think, and then you see headlines like this published the same day as Xi faces more doubts within China as global problems mount, and you can only wonder well, why would he be facing any problems if the economy there is in fact doing so well that it's poised to be at the beginning of a major run higher? Well, maybe things just aren't that good. For the world, the message presented will show the extent which China's mounting economic troubles, which doesn't make any sense given the recent headlines, at home will affect its policies toward global issues like Russia's war in Ukraine, which has stoked inflation and increased suspicion among U.S. allies and Beijing's intentions toward Taiwan. She expressed desire to push for peace and has been met with incredulity in the U.S. and has repeatedly warned that China may help Russia to prolong the conflict. But we notably here see economic troubles at home, and now we start to see this headline here: world's idled container ships signal bet on China's recovery. And that, my friends, that's a laughable headline. Bet on China's recovery? No, it's the exact opposite, because when you have idled ships, idle container ships, it doesn't mean there's a massive recovery. It means there's a massive problem, as we're going to look at here. And while they're claiming there's a bet on recovery, what there is a big problem here, because if there is no recovery, well, watch out below. But where those idle ships are clustered gives insight into the industry's bets for a rebound. A large number are positioned near China, waiting for a renewed flow of exports as the world's second largest economy recovers from its COVID zero restrictions. Now, this is just logic. If you're in the container ship business and you have an empty ship and you're saying, I'd like to get some business, where are you going to go in the world? Are you going to park it off, say, one of the U.S. coasts and say, hey, I hope you have some exports here? Or are you going to sail it over to the world's largest exporter and then pray that they have some business for you? And then when you look around and you show up to the party, you're like, hey, I'm here to get some stuff. And you look around and you say, hey, those are all my buddies' ships and they're all empty too. And you start to realize that, wait a minute, this isn't a bet on the global economy. This is just logic of where you would take your ship. But if there's not a major boom in exports, well, now you've got a huge problem. And it makes sense to be close to the main export centers to be in a ready-to-go position, which is merely stating the obvious, because now we got this week the trade balance or trade deficit data, and we see that the trade deficit is shrinking. And what you can note is in periods where the global economy is expanding, where you see this blue line headed lower, well, that means the trade deficit in the U.S. is expanding, which means we are importing more than we're exporting, which then would tell you that things in the global economy, there's demand there. So if these ships are not filling up or have nothing to even put in them, you can guess where the trade deficit is going, and you've already got an indication of where the global economy is headed. About 4.1% of global container fleet capable of carrying over 1 million 20-foot container boxes was idle in February. And if that sounds not too bad, that's double the amount a year earlier and near December's 1.07 million container boxes, which was the most capacity taken out of service since August of 2020. So again, we come back to this is a pandemic level numbers here of empty containers. This is a huge problem. This is not a sign of a booming economy, but a sign of one in danger. Spot container freight rates have fallen to the lowest levels in 2.5 years. Again, not an indication of demand or inflation, just the opposite, making it a good time to take many ships out of the fleet for maintenance as chartering schedules are less tight, and so owners are catching up on repairs because they have, well, nothing else to do. And the last time there were so many idle vessels was during the first part of 2020 when COVID-19 swept across the world and brought shipping to a halt, but that turned around quickly as consumers stuck at home and turned to e-commerce, kickstarting a scramble for all kinds of ships to transport containers. And so what did we hear yesterday? For those of you who watched the show, we heard from the regional Texas survey, the Dallas Fed say, and under the survey questions, people were commenting, things here hit a wall. And now you start to look at this shipping data. It is hitting a wall, and not just a normal wall, not just one that's like a speed bump in size. What you're hearing one is, we haven't seen it this bad since the pandemic. And now as we turn to an ongoing story, do we see other signs that the global economy is indeed slowing down? Well, yes, we just got this data right before we hit record. Crude oil inventories up 1.165 million, and normally you see imports were down 1.15 million, so we're still building despite a decline in imports. We see distillate stocks up a little bit, even though there was a bet on a decline. We see gasoline inventories, after building there for quite a while, finally showing some signs of demand as they fall. But again, we have this indication that the global economy is slowing down, that things in China are far worse than we thought. And if if these ships do not find a bunch of goods to get on there and sail across the world to drop off the U.S., it tells us not only is demand in China falling, demand in the U.S. is falling, demand in the Europe is falling, and this is the beginning stage, is what you're seeing now as the global economy heads into a massive recession. And now I'd like to take a look and introduce you to our sponsor for today's show, Renovo RX. Let's take a look over here. This is from their website, as they're developing innovative therapy for targeted treatment of difficult to treat cancers. And of course, we know that cancer is big business. There's lots of boomers headed into retirement. They're going to be looking for the latest and greatest technology. Renovo RX has that technology. We're going to put a link to their website, our analyst report, and everything you need in the description and comments. Put their symbol RNXT on your hot list, because you're going to want to take a look at this chart and do some more research. Let's continue on here. As Renovo RX, I want to introduce you to the company, and then let's look at the analyst report and the charts. Is a clinical stage biopharmaceutical company with a vision to disrupt the current paradigm of cancer treatment. The company's mission is to lead a revolution in oncology therapy by developing its innovative and targeted IA delivery of chemotherapy directly to solid tumors, and by delivering target therapy via the Renovo TAMP platform safely and without transmission to non-targeted areas is the primary focus for Renovo RX. And of course, we again note that there's going to be lots of people that are going to be looking for the latest and greatest technology. Renovo RX, symbol RNTX. Again, put that on your hot list. Now let's take a look at the analyst report here. And we see, I'll put a link to this again in the description and in the pinned comment, so you can take a look at the whole report. And now let's get into the 7 reasons why Renovo RX could be poised for some significant upside potential this year. We look for Senior Managing Director and Head of Biotechnology Research at Maxim Group, Jason McCarthy, PhD. He's got a $9 target on the stock, and that means we've got some major upside potential after bouncing off their 52-week low of $1.50 on December 6th of last year, and that could mean an upside of 500% if they reach their target. And of course, the stock has already made some major moves and is looking to make some more, putting this in a position when you see the chart that this thing is looking to go higher. Let's take a look further here, because it's an active chart, and we know traders, which many of you are, love to see activity in charts. After bouncing off its 52-week low of $1.50 on December 6th, shares have climbed as much as 187%. Can you imagine that? And it did it in 2.5 months. And one thing we know we love on this show, we love things like short squeezes. We also love low float stocks, and that is what Renovo RX is. They've got an extremely low float, as market participants consider a float of 10 to 20 million low. Well, look at this. Renovo RX, symbol RNXT, has less than 7.3 million shares available in float. So any kind of news or any kind of massive buying can send the stock price higher. And now let's take a look at the charts, because I want you to see where the analyst target is and why we think there can be a big move up there in the near future. Here we are on the 2-year chart. We've got the RSI turn on. We've got the MACD. We've got the volume profile. We know it's overbought, but you know, stocks can remain overbought for long periods as they make big moves. We can look at the MACD. It's not maxed out. It is headed higher. And look at this, going back over 2 years, $9.16. That's the volume profile. And what we're looking at here is in between and getting up into that big range of volume. There's not a lot of shares traded here. So what way we approach this is saying, we could see a big squeeze and move higher on this low float company that moves through this bundles of shares here, this small number of shares being traded before it gets to 771 and then upwards into that analyst target. So we see a lot of potential here as the stock is breaking out, and notably it's moving over its 200-day, 100-day, 50-day, and 21-day moving averages. That's the sign of a move higher. When you see a cross of the 50-day happened here and a reconfirmation, you're now making a move higher. And look, as we zoom in here to the 1-year chart, look at the volume profile. You can see over the last year lots of accumulation. We go back and look, you can note all this is under accumulation right here. The 1-year chart is verifying that. Let's move forward to the 6-month chart. Again, validate accumulation. Buyers are coming underneath this stock in quite a big way. And then you move to the 90-day, and what do you see? More accumulation. And even in the last 10 days before this gap up move the other day, you notice the buyers are buying at higher and higher levels. fundamentals, and that gives you a lot of confidence. And again, put RNXT on your research reports, put it on your hot list, do your own research, check it out before you make any moves there, because let's continue on. And there are other three reasons we think this stock can move higher. Is it has a high potential for growth. It's a nano cap company, which means it has to have a market cap of less than 50 million. And as of February 21st, is sitting at a market cap around 37.19 million. They've got strong intellectual property, and they were just received their 8th U.S. patent, so they are strongly positioned here as a leader in their space, and they've got a massive 1 billion addressable market. Of course, we know the pancreatic cancer and the cancer business in general is huge. Again, you have this massive wave of baby boomers heading into retirement. They're going to be looking for the latest and greatest technology. We know that RenovoRx has targeted technology. People are going to want it. They're going to demand it. And of course, symbol RNTX, put that on your hot list. And with any stock traded on the show, do your research before purchasing it. We've got a link in the description and the pinned comment for their website, for a research report, and go out and do your research. Check out the charts before making any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.